on your favorite show, The Mutual Fund Show.
The Mutual Fund Show Anniversary Special, only on Bloomberg Quint.
Thanks for joining us on Parlance. This is Bloomberg Quint. I'm Harsha Subramaniam.
Good afternoon. I'm Ira Dugal. Let's get you the headlines. Indian markets are set to end the week on a positive note. The Nifty trades near the day's high. The mid-cap index outperforms.
Sun Pharma and Mahindra are the two Nifty companies coming out with their earnings today.
The DMK and other opposition parties in Tamil Nadu have called for a dawn to dusk Bandh today.
Congress Ramesh Kumar elected Speaker of the Karnataka Assembly unopposed after the BJP withdraws its candidate. Chief Minister Kumaraswamy will take the floor test in a short while from now.
All right, but let's start with checking in on the markets and how things are shaping up. Neeraj Shah is here. Afternoon, Neeraj.
Hey, afternoon, guys. Really good, actually.
Yeah.
1% up yesterday. One would have thought that there was a flash in the pan, but no, the markets are up and about in today's session as well. And separating the wheat from the chaff today, the markets really. So, for example, metals are doing really well, but Vedanta isn't. That one is still down about 2.5%. But the other metal stocks have bounced back today. So the Nifty Metal Index up at the day's high. Tata Steel, a couple of others are doing rather well. Hindalco is up in the green. Vedanta isn't. So that's that one separate point. Two, I think the markets punished the upstream oil companies in a big way in trade yesterday. Was down 10% ONGC intraday. In today's session, a bit of a bounce back as well. So maybe the market is now waiting for the news to be out. Or maybe somebody knows that others don't. But there's a bit of a pullback for sure in some of the large cap names. Power as a sector has had some interesting moves today. We're trying to figure out if there are some definitive announcements that have come about. Couldn't find something too much that will have an immediate impact. But Torrent Power, Adani Power, GMR Infra, Tata Power, all of these stocks have had a fabulous move today. And on the small cap space, result reactions galore. So, Shalimar Paints for a second or third day in a row, some corporate announcements expected. That stock is up and about. A couple of other mid-cap names that came out with numbers overnight. Sudarshan Chemicals, for example, fabulous growth on the quarter, and that stock is up and about. And volumes by and large doing fairly well today as well. So it's turning out to be a happy Friday so far.
Good going indeed, Neeraj. Thank you so much for that. Let's move on. The world's most profitable banks can be found in India. So can the world's worst. While the legacy state-owned lenders are roiled by frauds and surging bad debt, the newest lenders are offering the best returns. Jeanette Rodrigues from Bloomberg News has put together a few charts to demonstrate where Indian banks compare to their global peers. Jeanette.
Hi, Harsha. Harsha, what we're seeing right now is that analysts are drawing a clear distinction between consumer banks, which give loans to people like you and me, people who banks that open deposit accounts, low-cost accounts. These banks are benefiting from strong economic growth. Consumption that's expected to continue quite strongly, whereas on the other hand, you have wholesale banks. These are your PNBs, your SBIs who cater to large corporates, and they're reeling under bad loans, as we know. Analysts are for the first time drawing a massive difference between these two banks, and you can see them in the valuations. You can see the ROE on banks like AU Small Finance, for instance. It's the best in the world if you look at a universe of banks with a market cap of at least $2 billion. That's the most profitable bank in the world, going by the ROE estimates.
Hold a thought. That's the chart on the screen of AU Small Finance Bank. That you're saying is the most profitable in that league.
Yes, banks with a market cap of at least $2 billion. Yes.
Go on.
Then by ROA also, AU Small Finance features among the top in the world. It's joined there by Bandhan Bank, of course, another small lender, which is also catering to largely the unbanked segments of India. Huge growth potential there. Completely unsaturated market. And as I said, you can see these in the valuations. You can see these in investor expectations. Very interestingly, also you have the price to book multiples. And even when it comes to price to book, you can see AU Small Finance, you can see Indocent there too. In the large cap space, you can see HDFC Bank. HDFC Bank, of course, 70% of its loans are retail loans, not the large corporates. So as I said, you can clearly see a distinction between good quality credit demand, retail demand, which is expected to stay strong. And of course, your wholesale banking, which is really not in a good shape at all right now.
There's a fabulous message in there, Jeanette, right? The PSU banks are the banks which have the strongest reach in terms of branches, in terms of the people on the street. But it is ironically these new age banks which are actually getting that business and being sort of rewarded for it.
Indeed, exactly. That's very well put, Ira. SBI, of course, the bank of the people, isn't it? But the message from the investors seems to be clean up your books. We need to see that recognition. We need to see you going where the profits are strong, where the growth is strong. We need to see you catering to what your mandate is, and not just large loans which never get paid back. Of course, as you can see, after SBI's record loss, shares shot up because investors expect SBI to do better going forward. They believe the worst is over. Time will tell if that's the truth.
Jeanette, thanks so much. It's a fabulous story, and that's up on the Bloomberg Quint website as well. But talking about banks, there are two important earnings coming out today. Bank of Baroda reports numbers, as does IDBI Bank. I'm going to go across to Shraddha for Bank of Baroda and then talk a bit about IDBI Bank after that. Shraddha.
At least as far as Bank of Baroda is concerned, the bottom line performance is expected to be much better than some of its PSU peers. While the Bloomberg consensus estimate, factors in a net loss of 28 crores, the estimates range right from a profit of 494 crores to a loss of as much as 950 crores. For most of the large-size banks, we did not even see analysts estimating a profit for the quarter. Having said that, the MTM provision reversal is likely to be used for shoring up the provision coverage ratio. Loan growth is seen at about 10%, and that's expected to be largely driven by the retail book itself. Gross NPAs are seen rising marginally from about 11.3% in the December ended quarter to about 11.5 to 12.2%. Slippages should see a sizable spike in this quarter from about 8,000 to 9,000 crore is the kind of estimates that we have seen, and this is as compared to the quarterly run rate of about 5,000 crores that we've seen in the first 3 quarters of FY18. Aside of that, the impending RBI divergence report is also something that the market will be watching out for, as is the management commentary with respect to the trajectory for its operating profit and stress book. We will, of course, be watching out for comments with respect to the asset quality trends for FY19 and looking at what kind of RBI dispensation measures that the bank has used during the quarter.
All right, Shraddha, thanks so much. That's Bank of Baroda. I'm told that analysts don't really have a view on IDBI Bank, but I'd like to say that it is perhaps one of the most interesting and important stories to watch in the banking sector. The reason I say that is this. Remember, when the Q3 numbers for IDBI got reported, it was already the bank with the highest gross NPA ratio at 24%. Net NPA ratio stood at 16%. And IDBI Bank is a large corporate lender. So if we have seen the likes of, say, SBI and others take a hit because of the February 12th circular from the Reserve Bank of India, it's a fairly reasonable assumption that even IDBI Bank would see some impact. Now, on the flip side, they have been unwinding some of their non-core assets, etc., trying to get money even from things like real estate sales to try and buffer up their balance sheet. But it'll be critical to watch what happens to their gross NPA ratio. Of course, where does it go from 24% already? That's a quarter of a bank's loans, by the way, that have gone bad. The net NPA ratio, how much they can manage to provision, and what their ROAs, etc., look like for the current quarter. The reason it's critical at this point is, remember, we have seen the RBI come in with a second round of corrective action in cases like Dena Bank and Allahabad Bank. Dena Bank being stopped from fresh lending, and Allahabad Bank being told not to expand its risk-weighted assets. So the key question to me is IDBI Bank, should they report even worse ratios, a prime candidate for stricter corrective action? So I think that's what we're watching out for when IDBI Bank reports this afternoon, Harsha.
Interesting that. Let's move on now, talk about the defensive space, Sun Pharma. They're reporting their earnings today. Darshan is standing by to tell us what we can expect from Sun Pharma this time around. Darshan.
See, Harsha, I think Pharma as a pack has reported weak set of numbers. On the top line, we are seeing a 6% decline. On the bottom line, we are seeing a 33% decline. And on the EBITDA margin front, we are seeing a 18% decline that will come in. Management post Q3 had guided for flattish sales QOQ and EBITDA margins to the tune of almost 20 to 22%. So pretty much we are coming in that level only. US sales are expected to be wobbly. They've already reported Taro numbers which were decent and better than what the street was anticipating. So that will play a factor. But overall pricing pressure is there in the US markets. Some of their key drugs that they have are seeing competition that are coming in. Absorica and Glivec are seeing increased competition and price cuts that are coming in. But Coreg is one of the products that they launch will offset the weakness that is there. On the India market, the rest of the world market and the API market, single digit growth is something that we can anticipate. But US will be the big one that we want to watch out for. And that is expected to be rather weak.
All right, the last of the tech counters on the Nifty, Tech Mahindra, is also expected to report numbers today. Agam, analysts are pricing in muted growth on that one?
That's right. We're not expecting any fireworks in this quarter. Let's start off with what our expectations are. According to the Bloomberg consensus estimates, we're likely to see about a 2.7% growth in revenues sequentially. EBITDA margin is likely to come in at around 13.6%, an expansion of nearly 90 basis points, and profits likely to see an uptick of around 1% quarter on quarter. Among the key watchables will be Comviva, which is expected to lend in terms of seasonal strength. Do remember, we are likely to see another subdued quarter when it comes to one of its other subsidiaries, LCC, that's Lightbridge Communications, which continues to show inconsistency on the whole. On the other hand, we're expecting the enterprise business to do well and lend strength. And we can also see perhaps about 100 to 200 basis points advantage coming out and playing out when it comes to cross-currency movements. That said, we are watching out for their performance in terms of inorganic growth, because a lot of their acquisitions are still to show up when it comes to their growth and top line. That's we're also keeping an eye on total contract value and deal wins in the enterprise segment. That's going to be crucial. But on the whole, we're expecting another quiet quarter from Tech Mahindra.
All right, that's Tech Mahindra for you. Let's move on and talk about fuel prices at this point in time. Fuel retailers have been hiking prices for 12 days now. Petrol crossed the 85 rupee per litre mark in Mumbai, while inching closer to 80 in the national capital after prices were hiked by at least 30 paise today. So prices have gone up once again, and the government is said to be contemplating imposing a windfall tax on oil explorers like ONGC to cushion this rise. The proposal is to ask explorers to transfer the extra amount they make once crude touches or crosses $70 a barrel. That's according to PTI. So does ONGC have the wherewithal to pay the additional tax if and when this is rolled out? And why is the government choosing to do this? And what's the idea behind it? Yatin is standing by with some answers. Yatin.
Well, first we need to understand why really is the government worried about rise in oil prices and how probably it can counter the rise in oil prices so that it doesn't hurt the general public and more importantly the voters. Now, if you look at the scenario which has been presented, of course, this is from a CLSA report. Now, a cut of 4 rupees per litre, if you want to do it for diesel and petrol, that will cost the exchequer nearly 50,000 crores an annum. So that is the kind of revenue loss we are talking about, and this is the cut that the market probably is looking at as far as the diesel and fuel costs are concerned, which are clearly hurting the people on the ground, and more importantly, that is the one factor which can be responsible for high inflation or imported inflation. Now, what happens if crude remains over $80 per barrel? That clearly will impact the GDP by nearly 40 to 50 basis points. So, increase in crude prices really hurts the gross domestic product. And what happens for every $10 rise in the price of crude per barrel, that impacts the current account deficit by 40 basis points. So that is a very hard impact, for every $10 rise in the price of crude per barrel. And what if crude stays above $80 per barrel? That will clearly impact the fiscal discipline. So the current account deficit can touch 3% of the total GDP if crude stays above $80 per barrel on an annual basis. So clearly that will not only hurt the economy but also the government finances and also the general public. So that is the reason why probably the government is looking to counter the rise in crude prices. We also have ONGC, which is adversely impacted because it's recently acquired a 51% stake in HPCL. all of that was funded through debt, and these are the banks which lent to ONGC for funding that 35,000 plus crore acquisition of HPCL stake, which was to the tune of 51% from the government of India. Now, if you look at the valuations, mouth-watering valuations for a company like ONGC, that is factoring in or pricing in a valuation of close to $50 to $55 per barrel, despite the fact that we are almost around $80 per barrel on the crude. Why such a discount in valuation is simply to do with the fact that the market is fearing that the subsidy sharing mechanism or the harsh subsidy impact could see finances of ONGC get impacted adversely. And this is the kind of scenario analysis that CLSA has done for a crude which is at $40 per barrel to the crude which is at $70 per barrel plus. And this is the kind of impact that can have on government finances. Right now, the government is, put or set aside a 15,000 crore subsidy burden that it can bear on its own when it comes to the LPG and kerosene under recovery. But as soon as this figure moves up $70 per barrel on an average for FY19, that subsidy for under recovery in LPG and kerosene would move up to 40,000 crore, which means that if the government is looking at bearing 15,000 crores, the remainder 25,000 crores has to be borne by the oil marketing companies or ONGC or Oil India or all of them. So, probably that is the reason why market was slightly panicking in trade yesterday. Shares of ONGC dipped as much as 10% in intraday trade.
All right, I think it'll be interesting to look at what the cash pile of ONGC is looking like now and how it's dwindled over time, but that's for another time. Let's move on. The Tamil Nadu government has transferred the district magistrate and the superintendent of police in Tuticorin as the situation continues to remain tense in the area. The main opposition party, the DMK, has called for a statewide bandh. Power and water supply to the Sterlite power plant has been cut off. Smita TK of the Quint is joining us on the phone line with the latest. Smita, can you bring us up to speed on the developments since about yesterday?
Yes. So since yesterday, after the Tamil Nadu Pollution Control Board, in fact, issued an order that it will cut down the water and power supply to the Sterlite power plant, we did speak to the residents of Thoothukudi to find out if that in fact made any difference to them. We visited people, victims at the government hospital. At least 13 have been killed and at least 70 injured. The police are still remanding several of them. Even as we speak, the situation is quite tense. And if you look at pockets that are fishing hamlets like Teresapuram, the tempers are quite high. In fact, they're so angry with the police at the moment that they barricaded the route to the area, that they put boulders and rocks prohibiting police to enter the area because they blame the police to create the entire riot, and because of which many lives were lost. Now, as we speak, the opposition party, DMK, has called for a statewide bandh. The Congress has also joined in. Several other fringe groups have also joined in. And DMK leader Kanimuri has been detained by the police. And all that they've been demanding is for the shutdown of Sterlite. Now, Madras High Court has issued a stay on the expansion plans of the plant. However, what the people primarily are asking for is a complete shutdown of the plant, which has taken a definite toll on the environment, the drinking water quality, and several health hazards. They claim that many have contracted cancer and even have breathing issues because of this reason. Until now, what has been a major bone of contention with the people there is that political leaders like actor turned Kamal Haasan, TTV Dinakaran, Vijay Kant, MDMK's Vaiko have all visited the victims at the hospital and at their residences. But the ruling party, AIADMK, not even a single minister has come to the district to meet and talk to these victims. Now, that is a great sense of worry, because after the entire line of events, they and just announcing a 10 lakh rupees as compensation, the residents believe is not enough, because at the end of the day, they want this particular cost to be attended to, and they definitely want the state government to step in and take action. And the new collector has come into place after this recent reallocation of the previous one. So the collector did meet the victims at the government hospital and assured complete medical help, but they want immediate action to be taken against the police personnel who are involved in this riot, and also for the Tamil Nadu government to shut down the Sterlite plant. Back to you in the studio.
Thank you so much for joining us with those details. That's the on-ground situation in Tuticorin. The DMK has called for a ban. It's becoming politically volatile. But let's also get the other side of the story. Let's talk to the management CEO of Sterlite Copper, Mr. P. Ramna, joins us on the phone line. Mr. Ramna, thank you so much indeed for joining us today. What's your assessment of what's going on? The Madras High Court has stayed the expansion. The Chief Minister is on record to say that Sterlite will not continue. What is your position right now?
Well, as of now, as is known, the consent to operate for the existing plant has been refused by the Pollution Control Board, and the next hearing is on June 6th. So we are awaiting that. And yesterday, of course, the Pollution Control Board has cut off the power for the plant and issued an order. That is something which we are assessing. What are the next steps? What are the next legal steps that need to be taken? However, we are very clear that we are a completely law-abiding company, and we will comply with everything, and ensure that we are fully compliant.
Mr. Ramnath, given the magnitude of protests that have taken place in Tuticorin and the response of the government in the last 24 hours, is Sterlite considering exit as an option at all?
No, I don't think we are considering any exit. I think we are, as I told you, we have always been a compliant company, and we need to take legal steps and see what needs to be done. And at the same time, also reach out to the local people and allay their fears, because I think they have been misled, and I don't think I think the need of the hour is to allay their fears.
Mr. Ramnath, what are the legal steps that you have on the table that you're considering right now? And also, can you just give us a little bit of an idea of the financial impact that the company has now that the plant is in operational?
This plant is currently under shutdown, as we said, for the last...
Oops.
Oh, okay.
I think we lost...
We seem to have lost that line with Ramnath, the CEO of Sterlite Copper. What he's saying that they're going to be looking at legal responses or legal next steps to ensure that the plant can come on track. But as it stands, the Madras High Court has stayed the expansion of Sterlite. The Chief Minister of Tamil Nadu has gone on record to say that Sterlite will be shut down. So it's going to be an extremely difficult battle from here on. Bring up the Vedanta stock for you to give you a sense of what's going on. Anil Agarwal has went on record to say that they will comply with whatever is necessary. That's exactly what the CEO is saying today as well. But they still continue to be hopeful that they will seek legal remedy and that the plant will come back on track. As it stands, the plant stands shut down. The Pollution Control Board has withdrawn its approval, and the electricity has been cut off.
Yeah, so I think what I wanted to ask him was what is the investment that has already been put in to this plant on the assumption that it does not come back anytime on stream?
So far, they've been saying that they've invested over 500 crore rupees as far as to ensure environmental safeguards. But clearly, that has not been enough because the local community is up in arms. So this is going to be a long haul. The Vedanta stock is down 2.5% in trade today.
All right, let's move on. I think we're unlikely to get that line back immediately and move to global news. A historic summit between Donald Trump and Kim Jong-un that was abruptly agreed upon has now been equally abruptly called off. Listen to what the US president had to say as he cancelled the June 12th summit with North Korea.
Based on the recent statement of North Korea, I have decided to terminate the planned summit in Singapore on June 12th. While many things can happen and a great opportunity lies ahead potentially, I believe that this is a tremendous setback for North Korea and indeed a setback for the world. If and when Kim Jong-un chooses to engage in constructive dialogue and actions, I am waiting.
US officials insist that they're optimistic that the meeting will happen eventually, while North Korea says they're willing to meet the United States at any time. Bloomberg's Sam Kim reports.
Trump is apparently angry about a comment made by a North Korean diplomat who said a couple of days ago that she basically called Mike Pence, the Vice President of the United States, a dull-minded person, something like that. And I think that really made a lot of people in the White House angry. And for Trump, it probably was very hard for him to go into negotiations with a country that calls your number two a stupid person. But, you know, tension had already been building before then, well before then, with John Bolton suggesting what he called a Libya model for North Korea. But that image of Libya is not really positive in North Korea. You know, they immediately think of the image of Gaddafi being manhandled and being killed a couple of years after, you know, he gave up the nuclear arms. So there's a lot of sort of a gulf of expectations here. What I found interesting in the North Korean statement hours after Trump canceled the summit was that, you know, they were saying that they actually had hopes, great hopes for what the White House called the Trump model. And, you know, North Korea's diplomat was also saying in the statement that they were actually internally having respect and admiration for Trump, you know, right before the cancellation of the summit. And they were saying that, you know, we're still willing to have dialogue. So I think there's room also in the statement released by the White House, you know, with Trump trying to be as polite as possible. I think there's, you know, some people actually see this as a bump. You know, Trump is what he calls, you know, he calls himself a deal maker, a very skilled deal maker. So, I mean, canceling the cancellation of the summit might also be something down the line. We don't know for sure, but I think there's a lot of room for further development in this case.
Donald Trump has been right on China for 20 years, according to former aide Steve Bannon. Bannon claims that China is working towards dominating the 10 very important industries by 2025, and that the attack on the U.S. is threefold. Listen in to a slice of the conversation he had with Bloomberg News.
We've learned a lot that we were told was not true by the global elites in the financial community and the corporatists that have exacerbated the rise of China to the detriment of the United States of America, and particularly the workers of the United States of America. Threefold kind of a three-pronged attack. Number one, tariffs, and not just tariffs, quad tariffs, but tariffs at a scale that have never been done before. $50 billion laid on the table, but in addition, another $100 billion and another $100 billion of that kind of implied. $250 billion of tariffs. Number two was the 301s about forced technology transfer. This is not intellectual property theft. This is where China, as a standard course of business, forces our technology companies to give their IP. Number three is the ZTE situation, where we saw that we could literally almost liquidate a company by cutting them off from the components part of the United States. I think this brings to reality what Made in China 2025 is all about. Made in China 2025 is another state-controlled enterprise where they're investing hundreds of billions of dollars to dominate the 10 most important industries in the future, and particularly advanced chip design, robotics, and artificial intelligence. And if they converge and control those in the next 10 years, they'll control manufacturing. What President Trump showed, I think in a very short period of time, is that the convergence of those three forces will break this kind of tap along that the Chinese have always done. The Chinese always want to be in a strategic economic dialogue, okay? They always want to take time and let's talk about it. You saw it with Chairman Li He. He was on a plane with a sense of urgency to come to Washington, D.C. after our team had laid out a 60-page report when they were in Beijing and said, hey, here's exactly what we need and here's what we're going to do to enforce it. The Chinese freaked out. They had a first time they've had a sense of urgency now.
So, but what should Trump be doing? You think he should push ahead with the tariffs? Wilbur Ross is supposed to go to China in a few days. There's divisions within the administration.
There's big divisions, yes.
And so what are you telling the administration on how to handle this?
I think President Trump's natural inclination, he's been right on China for 20 years. I think it's one of the central parts of why he's president of the United States. His whole populist message, this economic nationalist message, was about the central issue of our time, and that is the relationship between China and the United States economically, culturally, and militarily. And I believe that President Trump, because of a number of different factors, and he's trying to include North Korea into that situation, is looking at a grand bargain, okay, with pressure from red state Republicans in the agricultural community and Wall Street. I think they look to try to accommodate. My strongest recommendation is to be as tough and hard as possible. The Chinese will buckle. We know they'll buckle. President Trump brought them to Washington, D.C. for the first time with a sense of urgency that something had to be done. And I think if President Trump just goes back to his natural, no leader, remember, we were told from Bush to Clinton to Bush and Obama, this is not about political party and this is not about ideology, that it was impossible to stop the rise of China, that we had nothing we could do about it. And anything that we could do about it was tied to the SWIFT system or tied to access to capital markets. We literally had no other tools. President Trump, in less than 5 or 6 months, has put a lie to that. We have tremendous operating leverage, and we still have time before China 2025 comes into being to actually combat this. And if we don't do it now, we will pay a huge price. And I don't care if the stock market goes up for a couple of days. That's not relevant. What the financial community thinks about this right now is all short term. Okay, they think about the short term. And Secretary Mnuchin, who I consider a friend and he's a great guy, made a comment on the Sunday shows is dead wrong. He said, quote, "The trade war is on hold right now." Well, China hasn't put it on hold. China is still in economic warfare with us and is still in a trade war with us. We have unilaterally put it on hold. But I think as President Trump works through this with his advisors, Wilbur Ross and Mnuchin, Peter Navarro, and particularly Lighthizer, and what Lighthizer said on Sunday is extraordinary to me, that a U.S. trade rep came out and put a press release out on Sunday that said, hey, with all this talk you're hearing about that we're going to try to have some kind of deal or some rapprochement, remember, the forced technology transfer of our intellectual property from our tech community is the #1 central issue of where they're stealing our innovation. And we're going to take a hard line on that. So I think there's a lot to come in this trade situation.
The candidacy banner there. Coming up next, RBI may have to hike rates to counter the strengthening or the rising dollar, says Jahangir Aziz of JP Morgan. That conversation coming up on the other side.
Sir, please believe me, I am in this business for the last 12 years. Okay, I'll wait for your call. Thank you so much.
They still don't know you after all these years?
क्या करें? पहचान ही नहीं है.
Simple solution है. List on the stock exchange. With listing comes recognition. Investors get interested in you. And funding happens.
Come on, yaar. I'm not big enough to list. Chal, let's leave.
There's a stock exchange exclusively for your kind of company. NSE Merge. It's the right platform for your business.
Really?
Yeah.
My kind of company?
Exactly. Get listed, get recognized. अरे भाई हीरे की असली परख जौहरी को ही तो होती है. चल.
NSE Merge. साथ हमारा, सफलता आपकी. The SME Growth Platform from India's largest stock exchange.
White shirts, कितने plain और simple. Fog scent, plain और simple white shirt को बना दे special और fashionable. Fog scent, new fashion wear for men.
Catching up on news feels like a test match. Want the highlights? We hear you.
It's an ocean of news out there. Need a navigator? We hear you.
Do you have analysis paralysis? A case of too much information and not enough time? Do you wish someone would just pick the most relevant topics and tell you what you need to know? We hear you.
Good morning. You're watching Bloomberg Quint. This is First Word.
Curated and presented by Bloomberg Quint's senior-most editors. Weekdays at 8 a.m.
Hi guys. We're completing 1 year of the mutual fund show on Bloomberg Quint. Take a look at all that we've done over the last 12 months.
Optically, nothing is cheap.
Volatility is integral part of financial markets.
Prices change every microsecond and NAVs change every day.
I have been always suggesting that if you can be Kumbhkarna, invest today and go to sleep for next 14 years.
Join us on the next leg of our journey as we attempt to make the conversations even more meaningful on your favorite show, The Mutual Fund Show.
The Mutual Fund Show Anniversary Special, only on Bloomberg Quint.
Welcome back. You're watching Power Lunch. Let's take a look at the headlines. Indian markets are set to end the week on a positive note. The Nifty trades near the day's highs. The mid-cap index outperforms.
Congress's Ramesh Kumar is elected Speaker of the Karnataka Assembly unopposed after the BJP withdraws its candidate. Chief Minister Kumaraswamy will take the floor test in a short while from now.
Sun Pharma and Tech Mahindra are the two Nifty companies coming out with earnings today.
All right, quick check on how the markets are faring. It seems to be a good day for the markets this Friday. Agam is here with some of those key movers. Agam.
Well, extending gains, Harsha, right now. We're seeing the Nifty edge towards 10,600 and we're just a few points away from that mark. For now, looking good. The broader markets, the bounce is a little more prominent. We have seen outperformance when it comes to the mid-cap as well as the small-cap indices advancing by as much as 1.5, 1.6%. What's really standing out in trade today is the Nifty Auto Index, which is doing well, and this is largely on the back of gains seen in several auto companies such as Tata Motors. Tata Motors, of course, was weak yesterday, but we're seeing a little bit of recovery there. Maruti Suzuki also up as much as 0.5%. And the other sector which is doing well is the metal sector. We've seen good gains in Hindalco. That's up 5%. And we're also seeing Tata Steel up and about. That's advanced by another 4%. And that's the reason why we've seen that strength in the metal index, also lending strength to the major indices. Broader markets, once again, outperforming the major indices. And when it comes to turnovers, largely average, but all eyes will continue to be on earnings. We have Tech Mahindra and Sun Pharma, and we'll have to wait and watch as to what they can do when it comes to moving the indices going forward.
All right, Agam, thanks so much for that. Kaveri Seeds has reported a mixed fourth quarter set of earnings. To discuss the quarter gone by and give us the outlook for the next quarter, we are joined by Mr. C. Mithun Chand, whole-time director at the company. Yash Upadhyay from the research team takes this interview forward. Yash.
Thanks for that. So first of all, it's safe to say that it wasn't a great quarter when it comes to your bottom line, as you have reported a net loss of 18 crores. Can you help us understand with what's gone wrong this time around?
Good afternoon. Basically, if you see the business model, it's a very cyclical business, and fourth quarter is usually the very lean quarter for us. And usually we incur losses in the fourth quarter as we have fixed expenses and with a minimal revenue. So I don't think it is a disappointing quarter, but it will be, I think it's in line with the historical trends.
Okay, so the last time that we spoke, I remember you telling us that there is a shift in the focus to the non-cotton segment. What are the products that you are targeting, and what is your product pipeline looking like?
So basically, we have a huge portfolio, a good mix of cotton and non-cotton crops. And in the last 7-8 years, cotton was contributing to the major revenue. That I mean to say, more than 50% of the revenue was contributed by cotton in the last 5 years. So going forward, we are focusing more on non-cotton crops, especially like crops like maize, rice, pearl millet, and vegetable. These are the 4 crops which we are working on, and we see a huge growth coming from these crops. And overall across India, we see a huge potential for these crops, and especially for rice, we see a lot of hybridization. Pace of hybridization is also going up, and acreages in maize are also improving. So these 2 factors definitely will have a positive growth, and we see more than 20% growth for the next 3 to 5 years in non-cotton crops. And I think the non-cotton crop contribution will go from financial year 18-19, and eventually it will be, we will be doing more than 60% of the revenue from non-cotton crops. And non-cotton crops are more profitable than the cotton crop.
Right. And so with respect to expanding your distribution network, what sort of plans do you have there, and which are the key geographies that you plan to expand into?
We are a pan-India company, and we are present in almost all the geographies. But as we grow, we are intensifying our network. We are covering across all parts of India, and more specifically, we are expanding or intensifying our network in central and eastern India. So these are the two parts where we are concentrating more. And we have got a very strong network in southern India, and we have very good market shares in the southern and part of central India, especially Maharashtra. Other than this, we are improving our network, and year on year we are increasing the market shares, and we are expanding our network as well.
And so in terms of pricing, we're gathering that there is a lot of pricing pressure in the industry given the subdued farm income and the increased competition from the unorganized players. How are you assessing the situation?
So basically, if you see the total cost incurred for seed is less than 5% of the total input cost. And seed is a must product for the farmer to buy, and definitely will spend more on seed, because it actually tells how much yield he can get at the end of the day. So pricing pressure is there on the other commodities, but for seed I don't think pricing does matter for them. Usually they go for good seed for good yields.
Okay, sir. And finally, if you could leave us with your outlook for FY19, we have IMD forecasting for a normal monsoon for a third consecutive year. What is the kind of growth that one can come to expect in terms of both your top line and bottom line, say over the next 2 years?
By seeing the present forecast, and we have seen that the forecast is also good for the next coming monsoon. And in terms of our product lines, our products have done extremely well in both the market, central and southern India, both in terms of cotton and non-cotton crops. So we see a good market share gain in Maharashtra and Gujarat for cotton, and market share gain in non-cotton crops, especially maize and rice across India. So we think that we can grow in between 15 to 20% for the next year, with a better increase in the bottom line. And recently in the board meeting as well, we have announced for another buyback this year for another 200 crores. This is a back-to-back year. Last year also we have announced we have done a buyback of 200 crores plus a dividend. So even this year we are doing a buyback of close to 200 crores.
Okay, well, we'll leave it at that, Mr. Chand. Thank you so much for giving us an update with respect to your Q4 earnings. Back to you guys in the studio.
Yes, thank you so much for that. Let's move on now. Indian equities have delivered negative returns this year, but even amidst this falling market, some stocks have shown resilience. Darshan is standing by. He's put together a list of top performers and the impact that they've had on the benchmarks. Darshan.
Yeah, so Harsha, if you look at what's happened on a YTD basis, the Nifty actually has managed to just give flat returns. Till yesterday it was negative returns. Today's moved up close to 0.5% of flat return, but there is severe pain that's seen on the mid cap and the small cap. Now, if you see what's happened in the Nifty itself, if you take a look at which are the top gainers, which are the top losers, you can clearly see that, you know, it's 10 or 12 stocks. We have put a list of 10 stocks that have actually managed and where money is actually flowed in. So it's counters like Tech Mahindra, TCS, Kotak, Bajaj, and these are the expensive stocks. By no means these are cheap stocks. You know, TCS is trading at 24 times. You have Bajaj Finserv, which is trading at 4 times book value. IndusInd at 4 times. HUL at 55 times. Asian Paints at 50 times. So these are the biggest gainers on the Nifty. So clearly this gives an indication that money is moving towards more and more quality stocks, while the low PE stocks are not getting any kind of value at this point of time. And these are large stocks. Look at the weightages that they have on the Nifty, and look at the FI weightages holdings that they have. Like Kotak Bank has 40% FI holding, Tech Mahindra has 44% holding, and TCS has already reached a market cap of 7 lakh crores. Infosys Bajaj Finance has a market cap of 1,20,000 crores. So the point that we are saying is that, you know, don't be fooled by the move that's come in on the Nifty, because it's only these 10 or 12 stocks that have managed to move, and the Nifty has been managed by them. But apart from it, there is severe amount of selling that is seen pricing on the market, especially the mid caps and small caps. Some divergences that some things that I want to show you now. Look at the market cap of TCS. TCS has a market cap of 7 lakh crores. So that is Infosys plus Wipro plus HCL plus Tech Mahindra pushed together, and you put it another 1 lakh crore and you have TCS. So a lot of people on the street are justifying whether a 7 lakh crore valuation is justified for TCS when it's making similar amount of revenues and profits as an Infosys. The other factor, look at the FMCG space. Look at the valuations where money is moving in. Now HUL and ITC have similar market cap. HUL has caught up significantly. HUL is at a valuation of 55 times. ITC is at a valuation of 26 times. But yet money seems to be flowing into HUL. So that's a bit of a concern that the street also has. And look at the financials. So HUL has a financial of 34,000 crore on an FY18 basis. ITC is bigger. ITC has double the revenues and double the margins, yet money seems to be flowing into HUL, where the FI holding is also significantly higher. And look at the Bajaj, look at the FI holding in HDFC and HDFC Bank. So FI money is now being concentrated only on concentrated large bets. And the concern that the street probably have, if money is slipping from FI selling will happen, these are the counters that you need to watch out for, where money will flow out. Kotak Mahindra Bank's market cap is higher than SBI, although SBI has the largest asset base at this point of time. Interestingly, look at Bajaj Finance. The Bajaj twins have a market cap of 2.1 lakh crore, which is greater than all the PSU banks put together except for an SBI, and SBI's market cap is pretty much similar or slightly higher than the Bajaj twins. So clearly, if you're looking at the trend that's going on, despite weakness coming in the broader market, there are only these 10 or 12 stocks and which are very high value, very high market cap and high FI holding where money is flowing in. So you can either take it as money is moving only into quality stocks, or in case there is an FI or a global meltdown, probably these are the stocks in which which have moved up so much that could probably correct the most now.
All right, Darshan, thanks so much for that. It's the dollar strength that's driving capital away from emerging markets. That's the view coming in from Jahangir Aziz of JP Morgan. He believes that, like other emerging markets, the Reserve Bank of India may also need to consider rate hikes as a defense of its currency. He also believes that the Indian economy is facing tough times as the twin deficits widen, although there is some respite on growth. Listen in.
If we look at the way in which emerging markets have behaved over the last 20 years, the key driver of emerging market capital flows is two variables. One is the growth gap between emerging market and developed market. The larger the growth gap, the more capital flows in, simply because emerging market is a risky place to invest, so you need something to compensate you for the risk. Growth compensates you for the risk. The greater the compensation, the more is the capital flows. That's the key driver. And what we saw from 2010 to 2015 is that this EM-DM growth differential kept on falling almost relentlessly, and with that capital flows, and with that across every asset class, emerging markets underperform DM assets. And then we've seen this turnaround take place. From around first quarter of 2016, 16, 17, and till the first quarter of 2018, emerging market growth differentials widened in favor of emerging markets. That drew the capital. And if you look at any consensus view over 2018 and 19, you will still find more or less that EM-DM growth differentials are going to widen in favor of emerging markets, and therefore if the last 20 years has been any indicator, you should continue to see capital flows in. The other variable that has an enormous effect on emerging market capital flows is not interest rate. So if you look at interest rate differential, there is no real correlation between that and capital flows. Instead, it's dollar strength.
Okay.
So even if you take any kind of a measure of dollar strength, and we usually like to use just standard US dollar euro spot rate, that has a significant negative effect on capital flows. And so what we saw was that in 2016-17 up till the first quarter of 2018, in the absence of dollar strength, emerging market growth differential that was widening in favor of emerging markets, driving the capital into emerging markets. And then we saw in April the emergence of dollar strength, and that's the one that has pushed back the flows into capital markets. And again, as you were pointing out, it has been differentiated across the current account surplus, low-yielding economies, which have been less hurt by this dollar strength, and of course the high yielders current account deficit economies, which have been pretty much hurt the most in this emergence of dollar strength, as it should be. Okay. There's a reason why high yielders are high yielders.
Yeah.
They hide a lot of macroeconomic imbalance by that high yield.
Sure.
And consequently, when times are tough, the imbalances surface and they get hit.
But the last time we spoke, you said you don't expect the dollar strength to persist or at least, sort of extend in a big way.
Right,
but what about volatility? How much of an impact does volatility have on capital flows?
Volatility does have capital flows in the sense that, if you look at the last 20 years, 2000 and early 2000 to 2010, let's say, the time when volatility was pretty high or quote unquote normal, you had the largest capital flows into emerging markets.
Okay.
In the period from 2010 to 2015, when volatility was completely swamped down, that's the time when capital flows fell every quarter into emerging markets. So I know that there are a lot of people who believe that rising volatility, rising rates makes a difference, and I'm sure that at some point in time that might be true, but the last 20 years of evidence suggests that those are not the key drivers of capital flows. Instead, it's again EM-DM growth differential and dollar strength. And that's what we are facing right now.
Okay. Let me narrow this down into India. So how much of what India is facing right now, first on the capital flow side, is global and how much is Indian? Because I think we were looking at the debt numbers.
Right.
We're the worst in Asia in terms of outflows from debt.
Sure. And again, this is an emerging market. It's an emerging market within high yield or emerging market countries. There's a reason why we have to pay high yields is because we have chronic macroeconomic imbalances. Indonesia and India are the two countries in the Asia region that falls into that category. And what we've seen so far is that the rise in dollar strength accompanied by the rise in US rates has been one of the reasons as to why money has flown out. But I don't think that's the primary reason money has flown out. I think the reason why money has, or fixed income people have become, more skeptical about India prospects has to do with the fact that India is a economy where fiscal deficit was broadly around 7% for the last 3 or 4 years. Current account deficit, maybe for the wrong reasons, was broadly around 1%. Now we have fiscal deficit moving from 7 close towards 8. We don't know where it will go, but 7 towards 8, and the current account moving from 1 to 3. If you have an economy with rising fiscal deficit and widening current account deficit, two things happen. Interest rates go up and the currency depreciates. That's not the place where fixed income investors want to be.
Okay, but there are India-specific issues as well. Like,
which
for instance,
is the current account going
no,
down
I meant,
and the fiscal deficit going up?
I meant market structural issues, like on the bond side.
Sure.
I mean, this whole bond strike and all of that, what it's meant for rates, is that having a broader impact?
I mean, look, obviously the management of government borrowing in this particular time, there was a significant change from what used to be the case over the last 3 years. Not just in terms of the quantum that is being issued in the first half of this year, but also the tenor. So obviously the market has to get used to it. But I think more importantly, what we are seeing is that in the time of financial, when SLRs were very high and banks, public sector banks particularly, which were holding significant amount of bonds on their portfolio, could sort of blindly hold it till maturity and never really have to pay the price of change of marking their books to market. Suddenly, with the decline in HTM, is facing now a significant pressure on managing risks. And so I think one side of the market, which is typically where whether the private sector is buying or selling, the public sector has to be on the other side of it. The public sector banks are the ones who are in a transition period, getting away from the old model where they could hold a 10-year to maturity to now actually having to worry about mark-to-market losses. So yes, there has been these changes which have also affected them. But I would say again, on a broader macro basis, not so much the structural changes. I mean, suppose in this environment, current account was at 1% and fiscal deficit was coming down, even with the structural changes, I don't think you would have seen that kind of pressures on bond prices or on the exchange rate. That's my point.
Okay, got that. Okay, there are two tough decisions right now we are facing. One is whether we hike rates now, whether we should have even hiked rates earlier, if you go by, one view. So let me get your thoughts on that.
So I have a somewhat different thoughts than, say, of my economist Sajid, whom you talked to a number of times. I think there is a lot of emphasis on inflation process in India, and we tend to sort of think about that rates or interest rate movements are almost entirely tied to what future inflation will be and inflation dynamics. And I'm not saying that should not be the case. That should be the case. But I think at this point in time, I think the financial stability, you can use that as a euphemism for anything, whether it's banking sector profitability on one hand or the exchange rate on the other hand, comes into play. So my guess is that given the fact that you've seen almost 1.5 months of dollar strength, and the rupee has has depreciated, and we haven't really seen the end of the dollar strength. My guess is that this factor is probably going to play a much bigger role in the June meeting than I would say inflation dynamics. Inflation is moving up. Core inflation has become not just sticky, has also picked up. But I think that if exchange rate keeps on depreciating, whether it's through transportation prices or through imported prices, it will have a second round effect. So it's not just that it's being done for financial stability, but also for future inflation. But I would think that the June 6th, I believe, is the policy review call, would probably hinge on how Reserve Bank of India sees dollar strength continue and rupee, rather than what its views are on inflation.
So you won't be surprised if there's a rate hike? You won't say what the hell are they doing?
If, for example, if we continue to see dollar strength and the rupee heads beyond 69, etc., and continued rupee weakness, my guess is that just like Indonesia did, which didn't face any inflationary pressures, but did hike, you will see emerging market countries across the world hiking for financial stability reasons. And I think Reserve Bank will be part of that. The difference between that kind of hiking and hiking for inflation purpose is that you can probably get away with 1 or 2 hikes if you're just doing it for financial stability. If you're going to do it for inflation, you'll probably need to enter into a hiking cycle.
But the rate defense for the rupee, you think is going to be effective? I mean, it hasn't been in the past, although those are entirely different conditions.
Right, but the point is that if you do not use rate defense now, you have to depend on your other instrument much more. So
which is reserves.
Which is reserves. So in general, life is usually in between. You want to use all instruments that are at your disposal, and you can't really rely on a single instrument. So if we think that, look, we can get away by not doing anything on the rates but doing anything on the FX, then the amount of FX losses could be significant. I have no idea how much the FX losses will be. So you typically would want to balance the two of them. So you do a rate hike of 25 basis points or maybe even 50 if the dollar strength doesn't stabilize. And that means that you have to do less on the FX front if you are trying to slow down the pace or the path of depreciation. You really cannot go against the path of depreciation. This is happening because of global factors. It's happening because current account deficit is widening. So at best, you can smoothen out the path, which is, I think, what the RBI is trying to do.
Okay. On the fiscal side, the decision is on oil, right? Do you worsen your fiscal position by cutting excise, which you've piled on, and you have piled on, and I think you got stuck in a traffic jam because there was an opposition to oil prices. So there's that consumer versus fiscal debate.
Right. So and I think that and this is not with hindsight. Back in 2015, when oil prices started to fall, in 2016, we did write extensively about it. So I'm not saying that with hindsight, everybody has 20/20 vision. That perhaps we shouldn't have done what we had done, which is not allow the entire decline in oil prices from 125 to 25 to be taken up by a higher excise taxes, and then use that for public expenditure and capital projects. That was the basic formula at that point in time. First of all, the decline in oil prices had nothing to do with any effort done by India. So this was pure windfall gain. And we seriously took advantage of that to make sure that we were not forced to fiscally consolidate during that period of time. I think it's payback time. They need to go and let the excise taxes ease on the excise taxes and start cutting elsewhere to meet the balance, meet the deficit this thing, because the entire, it was a windfall gain and now it's time to give it back up. You cannot say that I'm going to take the windfall gain and not give it back. When the government decided to use the windfall gain for additional revenue, they should have known that there would be a time in the future when they would have to give it back. This is the time.
Okay, and it's come at a time when anyway inflation is picking up, and also there would be a growth impact as well, right? Consumer spending has held us up.
Which is typically why people don't use windfall gains for these purposes. You try to save windfall gains. You do that in your own personal accounts. If you do spend windfall gains, you do find that typically when you need the windfall to use that space is usually during a bad time. It's never really a good time. So yes, this is that when oil prices would go up, we knew that we would be under pressure, but that was exactly the time when we need to reverse the excise taxes. My economists tell me that almost 50% of the oil price today is some form of taxes, whether it's by the state or by the center. That's a very large amount of revenue stream, and neither the state nor the central government should have imagined this was going to go on forever.
All right, last question, Jahangir. Not all is bad. We've got a GDP number coming up. I think growth is starting to look steady, right? And investment is also starting to pick up moderately, but some.
Right. So, we went through two large shocks, right? One was the demonetization disruption, the supply side. Then came the GST disruptions. I think both those shocks are waning out, and obviously we are going to see a lift coming out from there. And it's glad to see that people are talking about investing again. People are talking about, credit growth is again picking up.
Yes.
Consumption is not doing badly. All of this should have happened about 2 years ago when the global economy was moving up in a synchronized recovery. We could not take advantage of it because of demonetization and GST. But better late than never.